Welcome back to the podcast. If you hold a self-managed superannuation fund, or if you've been watching your super balance grow steadily toward that $3 million mark, you need to listen very closely today. For the past 3 years, we've been talking about the proposed $3 million super tax. It was debated, it was tweaked, and it was delayed. But the waiting game is officially over. Division 296 is no longer just a proposal floating around Parliament. It has received Royal Assent. It's now a dated law, and the clock is already ticking. Today, we are going to break down exactly what this new law means for your wealth, why the rules are more complicated than a simple headline suggests, and the critical decisions you still need to make, whether you are hearing this before 30th of June or well into the new financial year. Before we dive into the detail, if you already know your super is sitting near or above $3 million and you want someone to cut through the noise for you, the team at Easy Super are the SMSF specialists who deal with exactly this kind of complex legislative change. We are offering a free 10-minute consult so you can understand where you stand and what decisions are still ahead of you. Go to easysuper.eu and book your free consultation. Let's start with the facts. What exactly is Division 296? At its core, this law imposes an additional tax on a portion of superannuation earnings for individuals with large super balances. If your total superannuation balance exceeds $3 million, the earnings on the portion above that threshold will be hit with an additional 15% tax. When you combine that with a standard 15% fund tax, you're looking at an effective tax rate closer to 30% on those earnings. And it does not stop there. The government introduced a second tier during the legislative process. If your balance climbs above a very large threshold of $10 million, the earnings on that top portion face an additional higher tax rate, bringing the overall effective rate up to 40%. Now, there is some good news here compared to the original terrifying proposals. The thresholds will be indexed to inflation starting from the 2027-2028 financial year, meaning they will grow over time. Even more importantly, the tax will only apply to realized earnings, not unrealized gains, which was proposed in the beginning. You won't be taxed on paper profits just because a property in your SMSF went up in value, provided you have not sold it. There is also a very specific carve-out for property investors. For the purpose of Division 296 tax only, your total superannuation balance doesn't include amounts arising from limited recourse borrowing arrangements, or LRBAs. If you have an LRBA in your SMSF, this is a critical detail that changes your threshold calculation. But here's where the reality of new law hits hard for SMSF trustees. The mechanics of calculating and applying this tax are incredibly complex. First, it is vital to understand that Division 296 is levied on you as individual, not on the fund itself. You will receive a personal tax assessment from the ATO, and while you can release money from your super to pay it, you cannot claim it as a tax deduction. And you only have 84 days to pay once that assessment arrives. Also, how the ATO measures your balance is tricky. Generally, they will look at your balance at the start of the year and the end of the year and use the higher of the two figures to determine if you are liable. However, there is a transitional rule for the first year. For the 2026-2027 income year, only your end-of-year balance on 30th of June 2027 is tested. Now, here's what I really want you to understand. There is not just one deadline with Division 296. There are multiple decision points, and some of the most important ones are still ahead of you, regardless of when you are listening to this. The first key date is 30th of June 2026. That is the date Division 296 starts. It's the date your fund's asset values are locked in for the purpose of CGT transitional election. If you have not already had your assets properly valued and your records in order by that day, you might have missed the opportunity to establish a clean baseline. But the second key date, and this is the one most people are not talking about, is the lodgement of your fund's 2027 SMSF annual return. That is the deadline by which you must make the irrevocable CGT cost-based reset election. For most funds, that lodgement deadline falls well into 2028. So, if you are listening to this after 30th of June 2026, you have not missed the boat. You still have a critical decision ahead of you. This CGT election allows your fund to adjust the cost base of its asset to their market value as of 30th of June 2026, so that only the capital gains built up after that date are included in Division 296 calculations. It sounds like a great deal, but there is a massive catch. This election is irrevocable. Once you make it, you cannot undo it. Also, it applies to all CGT assets held by the fund at that date. You cannot cherry pick which assets to reset and which to leave alone. Now, this is exactly the kind of decision that separates a specialist from a cheap online setup. When you use a low-cost do-it-yourself provider, they hand you a trust deed, give you a login, and leave you to fend for yourself. Your do-it-yourself providers or general accountant do absolute minimum. They are not modeling CGT election will save you money or cost you a fortune over the next 20 years. They are not telling you that you still have time to get this right. Easy Super are SMSF specialists. This is what we do every single day. We will run the numbers on your specific asset mix. We will handle the actuarial certificates required for multi-member funds, and we will flag the traps that do-it-yourself trustee simply doesn't know to look for. Whether you are preparing for 30th of June or you have already crossed into the new financial year, the decisions ahead of you are too important to guess at. Book a free 10 minutes consult at easysuper.au to understand your options. There is another layer here that most people miss entirely, and that is estate planning. If you pass away during an income year, a Division 296 liability will still be issued based on your attributed earnings in the year of death, and it can continue in subsequent years until the death benefit has been fully paid to your beneficiaries. Your executor and your family could be dealing with a tax bill they never saw coming. And beyond the CGT election, there are ongoing decisions to make every single year. How you structure contributions when you realize gains, how you manage rollovers between the funds, and how you plan withdrawals. All of this now carry Division 296 implications. This is not a one-off event. It's a permanent change to the superannuation landscape, and it requires ongoing specialist guidance. A do-it-yourself trustee simply doesn't know what they do not know. And with Division 296, what you do know can trigger massive, irreversible tax consequences for you and for the people you leave behind. Whether you are hearing this before 30th of June or after, the reality is the same. Division 296 is law. The decisions it demands are complex, and the consequences of getting them wrong are permanent. If your superannuation balance is getting close to $3 million, or if you hold significant assets like property or crypto in your SMSF, you cannot afford to navigate this alone. You need expert eyes on your fund. That is why I want to take one simple step today. Reach out to the team at Easy Super. Go to easysuper.au and book your the free 10-minute consultation to talk about Division 296 in your SMSF. Do not wait until the ATO sends you an assessment and you have 84 days to scramble. Do not wait until you have already made an irrevocable election without understanding the full picture. Take control now. Thanks for tuning in today. Make sure you share this episode with anyone you know who manages their own super. They need to hear this. We'll see you next time.